G'day, Scutty here. Another very eventful week, but no chalk and cheese compared to what we we're talking about this time a week ago. There's been a complete about-face sentiment when it comes to the trajectory for the US economy, and that's really been reflected in what we're seeing across markets over the past 5 trading sessions. You couldn't have hoped for a better outcome when it comes to the data and the information that came through about the US economy to go and set the scene and maybe appease some of those concerns that were out there about the US entering a recession. Let's have a quick look at what was going on the calendar. You can see here, just going bring it up for the United States. And as mentioned, you can see that it was really, you could not have got a better outcome. Core PPI to go and kick things off on Tuesday, flat against expectations of 0.2. So upstream price pressures, nowhere to be seen. Maybe some concerns about what that implies for demand, but then that was addressed 24 hours later when we saw the CPI came in with the core at 0.2 in line with expectations. Really importantly, that implies not hot enough to go and prevent the Fed from cutting rates next month, but not cold enough to go and stoke concerns about the demand outlook dropping off a cliff and the implications of what that would mean for the economy. So really, really important piece of information, that particular one. And then you look at what happened out overnight. Yes, the industrial production data was not fantastic by any stretch of the imagination, but the most important part of the US economy, make no bones about it, is the US household sector. So what do we care about there? We care about the labor market, and we care about how they go and spend their dough. Well, you couldn't have got better information on that front as well. Jobless claims down again, and kind of reversing the pattern that we'd seen in the prior 5 weeks, where there were these violent moves in the opposite direction to what we had seen in the prior week. This time, we've now seen 3 falls in the past 4 weeks, which I think is important as a signal, because a lot of people are looking at the drift higher in the 4-week moving average and using that as maybe a catalyst to go and permeate those recession fears across the US market. And then, of course, retail sales last month, really, really impressive numbers and defied expectations. I know that I was doing some analysis this time yesterday, talking about how we hadn't seen 3 consecutive gains coming through in this particular series since 2018 in the control group, which feeds the GDP. Well, just look at the details all across the board, big beats coming through. And surprisingly, a lot of it came through in the auto sector. We know that a number of auto manufacturers are cutting rates right now, cutting the prices on their cars to go and stoke demand. So maybe that's having an impact coming through. But at 1% for retail sales in July, that was the biggest increase that came through since the start of 2023. So pretty impressive. So you can understand why the markets have really pared back those recession trades that were all the rage early last week. And because of what we're seeing this week, there's been an important shift in mindset as well. For a long period of time, the onus was on the data to show that the US is entering recession. Now it's that it's not entering recession. And at the moment, the data is certainly giving us a lot more comfort that, hey, potentially that payrolls report that we received 2 Fridays ago, that really kicked off this knee-jerk selling reaction and that unwinded some of the carry trades, maybe was an aberration. Maybe it wasn't the signal that we're seeing the US entering a recession. It's important when it comes to what's been going on when it comes to rate pricing as well from the Fed. Let's have a really quick look and see what's priced in now over the next year or so when it comes to rate cut expectations. Even with the data that we're seeing this week, we've still got around about 7 rate cuts priced in to the Fed funds curve out to June of next year. So that's still a pretty chunky amount, but it's 50 basis points less than what we're talking about on Monday of last week when that panic gripped Japanese markets in particular. Now, if you ask me about directional risk for this in the week ahead, well, I'll go to it in a second, but there's not a lot on the economic data calendar that suggests we're going to go and see a pullback in the other direction. And have a look where we're sitting right now. You can see here we've actually returned to the levels where we're at just before that non-farm payrolls report hit. So we've retraced some of that move. And then I look at this area up here where we went and added another cut and a bit in the prior few days beforehand. And that was driven, of course, by that weak ISM manufacturing PMI and the initial jobless claims spike to multi-year highs that really, really got the market concerned about that recession. Well, the signal from initial jobless claims has been invalidated. It's gone reverse that spike. So is there a justification to go and still be lower than that? Well, I'm not sure. And no disrespect to the manufacturing PMI, but we're talking about a part of the US economy which is worth less than 10%. And the ISM services PMI, which is worth more than 80% of the economy, were showing pretty robust growth in the course of July. So to me, the signal is, well, I'm not sure whether we're going to go and see much more downside here unless we get a really kind of grey swan or a black swan event or a big escalation in tensions in the Middle East, because it just doesn't have that justification. Potentially, we might go and see this start to go and move back higher over the course of the next week. So we might see an extension of some of the moves that we've seen in markets over that period. Really quickly as well, US two-year Treasury yields have been really, really important when it comes to a lot of markets. And you can see here, they too have returned back to kind of the levels they were at before payrolls. Again, what's the justification to go and push lower from here? Well, there's not a lot when we look at the incoming data calendar, which I'll get to in just one second, and potentially maybe there's some room to go and push higher, depending on what happens over the course of next week. On that front, if this week was chock full of important data releases on what's going on in the US economy, next week is dull and probably good news for risk assets in general. You can see here, Fed speeches are out and about, a few bits and bobs in that particular front. You can see here that there's absolutely nothing really major to go and speak of. We have Chicago Fed National Activity Index, a soft survey, not really going to move things around. Jobless claims, unless we see a big reversal, a big spike, is that going to go move the dial? Where I'm doubtful. And the S&P Global Composite PMI has been coming out really, really strong relative to the ISM figures for a while now. So again, I don't think it's going to really change the message unless we see a big, big reversal from those trends. So again, where are the catalysts in that particular data calendar to go and say, well, we've got to go and see yields pull back and go and ramp up recession fears? I just don't see it on the calendar. Now, a few people who have been around the markets for a while will be looking at this particular event right here. Jackson Hole, GFC, post-GFC, other periods of time, has been used as an event by the Fed in particular to go and announce major policy shifts that have had really big impacts on financial markets, like Operation Twist, QE announcements, and the like. Now, this event has that same ability, of course, but what is the Fed really going to go and tell us that we don't already know? We already have 7 cuts priced in until June next year. We've got 3 priced in over the remainder of this year. The only way I could go and see it realistically is that maybe the Fed might try and push back a little bit against that market pricing rather than actually go and add to it at this point in time, which again points to the potential that we might go and see those 2-year yields start to drift higher again after the move we've already seen this week. So an extension of that move. Elsewhere, things that I want to go and cover as well is just the influence that the short end of the US curve has been having across a variety of markets. So this is the correlation analysis that I like to go and look at. Many people have probably seen it before. 20-day rolling correlations, they give them the take what's been happening over the past month on a daily basis with 2-year yields and a variety of different market variables. And first things first, the vice-like grip that we saw on markets such as the S&P 500 futures, NASDAQ futures, and other large cap equity indices around the world, the 2-year yields had for a large chunk of the past fortnight or so, has started to weaken recently. But the more high beta plays on risk assets, and I'm talking about the likes of dollar yen, Nikkei futures, Russell 2000 futures, and Bitcoin, they have all still been moving in vice-like moves with what's been going on with 2-year yields. You can see here, dollar yen is sitting at 0.97, so you might as well just go and tie it at the hip. It's moving in the same direction. Nikkei is a little bit weaker at 0.8, very strong with Russell at 0.9, and even Bitcoin at 0.84. So some of those markets have been lagging the move that we'd seen in other large cap equity indices and other risk assets over the course of the past week or so. But with that big shift higher in 2-year yields that we saw overnight, they too have joined the party. So that's a really, really important signal for me that we might see a further extension of some of the moves over the past week. Let's get to some of the charts because I want to go and look at the Nikkei and I want to look at dollar yen here, all in a weekly time frame because I just love the simplicity and the price signals you get from it. To say we've got a pretty important close coming up today for dollar yen is an understatement. You can see here at this point, we're on the cusp potentially of forming a morning star pattern. I'd love to go and see this particular weekly bar go and close back up above 149.5 or so, because that to me would go and suffice that criteria for that particular pattern. It would also bring the price back into that Jan 23 uptrend which is a really, really long run and important one to go and look at. You see here as well, around about 148.90 as well, has been a level where the price did a little bit of work in the past. If it manages to go and claim that area, then of course we can go maybe talk about 150.90 and that really key level above of 150, 195, 152, whichever you want to go and use. But it's looking constructive, but you want to see a little bit more upside to go and start dreaming about upside next week, in my opinion. Given how closely correlated the two are as well, we'll have a quick look at what's going on when it comes to Nikkei futures, because they too are looking pretty bullish right now. Indeed, the setup actually looks a lot better. You can see here it's managed to reclaim that 2023 uptrend. You can see a big bullish bar this week. And look, considering where the other price did some work earlier this year, who's to say that we can't go and push back up towards 39,815? That's one of the other levels I'll be looking at. On the daily time frame as well, have a quick look at the 50-day moving average, because that has been an area that's been respected a lot in the past. So that's one thing as well, if you like to go and look at shorter time frames. I don't really have any list of particular markets out there that I want to go and cover, so I might just go through some of the ones, obviously being based in Australia, have a quick look at, say, what's going on in the Aussie dollar. Well, it's looking pretty good. Bounced back really aggressively after breaking that long-running uptrend dating back to the start of the pandemic, and then it's managed to go and kick on and push above that former support zone there. So that's really nice setup at the moment. Potentially, should risk appetite go and hold in there and we not see a too aggressive move higher in US shorter dated yields, the Aussie, as long as risk assets hold up pretty well, the path of least resistance is likely to be higher on that particular front. Euro is looking pretty interesting as well. It looks like it's going to go and potentially go and break out of this this triangle that's been in over the past year or so. Not definitively at this point in time, it's got to be said, but you can see here after that false break last week, it went and had another crack, and at this stage it looks like it might go and close unless we see a big reversal towards the close. So I don't mind that at this point of time as well. Gold, it's looking at record highs, but it's not quite there yet. But you can see there, it's sitting in a nice uptrend at the moment, finding support. And all things being equal, as long as it's if it's a risk-off environment for an extended period of time, gold is likely to go and benefit. If it's a risk positive and the US dollar starts to soften a little bit potentially over the medium term, if we see interest rates from the Fed reduce as well, historically we know that there are really strong tailwinds when that happens. Softer dollar, lower bond yields, lower real bond yields in the United States. So who's to say that we're going to see gold continue to go and push higher and break to fresh record highs as well? So look at ASX 200 SPY. Nice little reversal. Looks like it's going to be a bullish engulfing on the weekly candle for futures here, and back through that uptrend that had been sitting in for the majority of this year. I've just highlighted here a couple of the other red dots. That's it's been pretty obvious on dips below 7,500 recently. We've seen the ASX 200 SPY bought, and at this point in time, if it manages to go and hold this level, and it certainly looks like it will in towards the close today, who's to know that we won't go and revisit those highs? Yes, from a fundamental perspective, the index is really expensive, ex materials, ex mining, but the price action says it wants to go higher. So I'm not going to go and argue with the price action. Let's have a look at some of the other big boppers in the United States. Yeah, this looks pretty decent. Yeah, Morningstar, unless we see a big reversal. And right now, you can see here, the price is on the cusp of going and reclaiming that uptrend as well. So again, another pretty bullish setup for myself. Don't mind it if it closes above here. Potential setup would be you could go and buy this, stop below the trend line, and then maybe target the record highs that we hit a couple of months ago. Nasdaq's looking just as good, same kind of setup, Morningstar, and it bounced really handsomely off that long running uptrend as well. And you can see here, I'm going to zoom in a little bit on the chart. 19.7, the price did a bit of work around that particular, so that's an area to keep a close eye on and potentially go and build a setup around. If we break through that, stop below, you can go and target upside towards the record highs. If it fails, then you can start to and set it, stop above, and look to go get some downside, assuming that we'd go and see a break. But for the moment, certainly the rebound that we've seen and with little in the other economic data docket to go and get us to be concerned about a major shift in sentiment towards the US economy, the path of least resistance, based on what we're seeing right now, fundamentally and from a price perspective, seems to be higher. Let's go finish off with iron ore, because I know there's a lot of people, particularly on social media, follow me for iron ore, and I've been pretty vocal that I think it's still ridiculously expensive at these levels, but I've been saying that for a while, and it's difficult to go and get excited about extended downside, but maybe, just maybe, we're on the cusp here. But I would have loved to have seen it's a really bearish weekly candle, don't get me wrong, and it's when it fell to multi-year lows earlier this week, but it's just managed to go and claim that 94 level, which was the prior low that we hit back in May of last year. From a fundamental perspective, from a steel price perspective, which is really, really influential when it comes to input materials and prices such as iron ore, I just don't see it. But right now, the price action, if we're going to go and get excited about an extended breakout, we have to go and do away with this level, in my opinion. It's not yet oversold on a weekly time frame. And clearly in a descending triangle pattern. So bang, 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 and we're going to go down here. Well, those who are short would certainly hope so. Those who are long will be obviously looking for a rebound from this level, where it has gone and done so in the past. Before we go and wrap up things, I might just go and put up the disclaimer on the screen here, and then just have a quick chat and see if there's any questions that are coming through today. Shoot them through on the YouTube live, and I'll have a look at it. Otherwise, we'll wrap it up and we'll go and enjoy our lunch on Friday. I can't see anyone typing at this point in time, so maybe I was just so extensive in my coverage that everyone's had their questions answered. But look, thanks for you who joined us live, and those who are watching on delay. Have a wonderful weekend. Best of luck with trade.